Have you heard of a cost segregation analysis? This can be a great way to save yourself a lot of money on your tax return if you have rental properties. And in today's video, I'm going to dive in to how this can be a great strategy for you. When you purchase a rental property as an investor, obviously we'll record your rental income less your rental expenses. And one of those rental expenses is depreciation of that property. The land does not depreciate. However, the building itself does depreciate. If you have a residential property, that building will depreciate over 27 and a half years. If you have a commercial building, then that's going to be a 39-year depreciable life. What a cost segregation analysis allows you to do is it allows you to accelerate that depreciation and take more of it up front to help you have a larger loss and get a bigger refund now. This can be great when you have startup expenses for your new rental property business, and the cost segregation analysis can obviously get you a lot of money back in the first year, and it can be a huge tax savings. The way this works is you will have to hire a professional, an engineer, to do a study. It's a cost segregation analysis study. What they'll do is they'll come and they will put eyes on your property, and they'll do a full analysis and report. And really the goal is they're breaking out the property in different buckets. So for example, the foundation will be one bucket, the drywall, the furniture and fixtures, the framing. These different parts of your rental property will be put into different depreciable buckets, meaning certain buckets, typically interior drywall in, have a faster depreciable life than, say, the framing. And so what you're able to do is you're able to segregate parts of the full cost of the building and accelerate that depreciation and have more of a loss up front. This can be a great strategy if you're a real estate professional, if you're using the short-term rental loophole, which we have videos about, and then you can use this loss to help offset some of your active income. This is something that's very important to consult your CPA or a tax professional about, because everyone's situation is different. If you're not a real estate professional, if you don't qualify for that IRS classification, if you're not doing a short-term rental, if you don't meet the material participation thresholds, then it's possible that even if you generate a large loss, because it's a rental activity, therefore it's a passive loss activity, there are limitations, meaning that you may not even be able to use that loss in this year. So it's very important to make sure that you meet the criteria to be able to offset your active income with a rental loss, because the IRS has a couple ways to do that. We have other videos about that, which we'll link below. For cost segregation studies, they typically cost a few $1,000s. And so this is another thing to consider. Now, obviously, this initial cost is a very small fee in comparison potentially to the deduction that you might be able to take, meaning you might be able to get back a large refund by accelerating that depreciation up front. So it's something to consider if you have a rental property and you meet those criteria to offset your active income with the rental loss. If you're not already subscribed, please do subscribe to this channel for more content, and we will see you next time.